Steve Fried is joining us with this week's Ag Week Market Extra. And Steve, the big headline news this week was about this $12 billion trade compensation package the administration is going to be giving to producers. Soybeans have been hurt the worst. So talk a little bit about what it means for that soybean market.
Well, I think first of all, the perception is that this suggests that the trade war will continue for some time, and that this compensation is to help farmers where prices went down. It could be anywhere from $1.10 to $1.50 per bushel for the 18 crop. It doesn't necessarily mean that soybeans rally, because right now China may not buy any beans from the United States in 18 and 19. They're going to focus a lot on Brazil. They're going to focus on a lot of other proteins. Their hog numbers are down, their margins are down, and their economy is slowing. So I don't think it means any more demand. In the July crop report, the USDA had a model in which they tried to interject what they feel the tariffs meant. They raised Brazil exports, they lowered China imports, and they lowered U.S. soybean exports 250 million bushels. And so I think with a 580 carryout, that's still negative to prices. If we move forward and say, okay, let's look at the crop ratings, what is the actual yield going to be this year? Some people think it's going to be a record 50 bushels per acre versus the government's 48.5. So that's going to add about 200 million bushels to that 580 carryout. So, you know, price-wise, that's still negative. So this aid package is going to help the rural community, and it's going to help the farmer. And what he does with that probably reduces some of the soybean marketing that he was planning on doing, or maybe forced to be doing, and he should use that money to pay off debt.
Right, and right now they're below the cost of production, so they probably aren't going to do any sales anyways. But let's figure that at some point in time we get a deal with China. How much of a rebound do you expect we'll see in the market?
I think the market perceives that this $2 break, maybe as much as 80% of it had to do with the trade war. So I think farmers perceive that we could see it, let's say after harvest, before the next South American crop, maybe $1 rally if they were to solve it before the next Brazilian crop. The problem is that a lot of people feel that this is going to go on for at least another year. So, you know, it may not be until the fall of 2019 until they decide, because the most important part of the controversy is the intellectual properties, and the Chinese are not going to give up on that. And so you have to find some kind of middle ground without that to come up with a resolution.
The price leader in the grain market has been wheat on some global concerns. Talk about what those are.
For the last, let's say, 2 or 3 weeks, we've been talking about a lower European crop, a lower Russian crop. This is on the heels of a lower Australian crop, and we had a little bit lower U.S. hard red winter wheat crop. And now we're talking about dryness in the western Canada prairies and maybe a lower Canada crop. So, number one is when you look at global wheat stocks and you take out China, the stocks are usage ratio are the lowest in 20 years. And so that kind of demands a higher price. So we're up against some of the resistance levels from earlier in the year. For nearby Chicago and Kansas City wheat, if we're going to push through the 550 and maybe 570 area, we're going to have to see export demand come into the United States from buyers who may not be able to buy from the Black Sea, or who are counting on Europe. This week, Egypt came in, they bought wheat from Russia, Romania, Ukraine, so that was our first chance to see a buyer maybe buy from the U.S., because if we look at October forward, our prices are competitive versus the Black Sea. So, you know, we're kind of looking for the possibility that maybe after the first year, we're going to see a big pickup in demand for U.S. wheat, and that's when the market maybe will test the $6 level.
How hard is it going to be to get to that level, though? Unlike corn and soybeans, you don't have the funds heavily short in those markets like you do in the row crops.
Well, I think that a lot of the momentum traders trade every market. And so maybe they're long crude oil right now, and maybe they're short bonds, and maybe they're long the stock market. Well, it doesn't, you know, they can be long as much as 100,000 contracts of wheat. So if they have a story, they could come in here and they could buy wheat. So the rally from here is going to be all about consumer buying, and the chart's looking positive. The perception is the hard wheat farmer has already sold the crop. He's already merchandised the crop. And so now what does the spring wheat farmer do? But the main thing is, what does the world buyer do? Because right now wheat is still cheap. And so, like corn is still cheap. And so the big thing is, does somebody come in and buy our wheat? Because for wheat, the first place wheat goes right now is into storage because of the carry. And so we just have to find another demand spot for wheat to push it higher.
The corn market was looking like technically it was trying to bottom here even before wheat took off. Now that wheat has taken off, does that confirm that we'll have a low or put the low in the corn market?
I think corn has already made a low. It doesn't mean it's going to rally. And the funds are still short about 50, maybe 60,000 contracts of corn, which is a very small, short position. We have to get through the August crop report, in which a yield come out, a record yield. And then we have to get through, maybe the farmer sells a little corn and stores his bean because of this aid. But I think the market's going to absorb it. You've got more cattle on feed, you've got more hogs on feed. You've got the ethanol market squeezing out quite a bit of ethanol, and then you're going to have a record amount of corn exports. So right in gut slide at harvest time, you're going to see a pretty good loadings of corn at the Gulf to pull corn out of the farmer's hands.
Any general marketing advice as we get into the fall harvest time period for all of the grain sector?
I think that if you get closer above 380 in nearby corn, $4 in D's corn, you should let the corn go. The one thing about a rally in a big crop is that the basis might have some pressure, and so you want to be ahead of that basis drop. For beans, you probably want to wait and see just how high beans go. $9 is a really good price that we're still 60 cents away from. So you probably want to wait for that. And as far as wheat is concerned, we have a weather problem this year. We may not have a weather problem in 2019, so let the wheat go.
High crop ratings, do you think, will that translate into much bigger yields in the August report?
Whether the USDA says it, in August all they're counting is corn stalks and soybean nodes, and they're putting on an average ear weight and size. For corn, the last 3 years, plant population is actually coming down. That means genetically we have a heavier ear, and so that didn't go away. So a 174 corn yield by the USDA is probably going to be someday a 178. The heat at night probably kept us from having a 180 corn yield nationwide, but in the heart of the Midwest, you've got a lot of corn. For beans, August weather is always key to beans. You get 1 inch rain across most of the Midwest. Keep these temperatures down, you're going to have 50 bushel beans, which will add 200 million bushels to the carryout. If I add 300 million bushels to the corn carryout, it's not a game changer. It's not, hey, let's make new lows, because the demand is going to absorb that. But whether they say it in August or whether they say it in November when they have harvest data, you're probably looking at a record U.S. corn and soybean yield this year.
Well, some great insight as always. Thanks so much, Steve Freed, joining us with this week's Ag Week Market Extra.